One of the most common questions I hear is, should I buy a home now or wait for interest rates to drop? As a homeowner that's buy homes in both high and low interest rate times, and a realtor of 14 years here in SoCal, I've learned some key do's and don'ts when it comes to buying a home during high interest rate times. And today, I'm sharing those lessons with you. Make sure to stick around to the very end because I'm going to share a bonus lesson that is timeless and you'll need to know in any market. Let's start with the top 4 things that you should be doing when interest rates are high. Number 1, focus on monthly payment, not just the interest rate. Work with the lender to calculate the monthly payment that feels comfortable for you. And focus on that number, not just the interest rate. Keep in mind that your monthly payment is going to depend on more factors than just the interest rate, including purchase price, down payment, property taxes, insurance premiums. The point here is that you have multiple levers to adjust and pull from in order to arrive at a monthly payment that feels comfortable for you. So you see, interest rates should not be the sole focus. I'm Melissa Urena, Long Beach local and SoCal Realtor. I help home buyers like you buy homes strategically so that your first home can be a stepping stone to your forever home. Make sure to like and follow. Number 2, explore loan products that help lower your monthly payment today. Ask a trusted loan advisor how you can use any of the following to help lower your monthly payment. ARM loans. These loans start with a lower fixed rate and then change over time. For example, a 10-year ARM would give you a lower fixed rate for the first 10 years of that loan and then adjust at year 11. Temporary buy-downs. A 2-1 buy-down is an example of this. It's going to give you a rate that's 2 points lower in the first year of your purchase and 1 point lower in the second year of your purchase. This means that if the going rate is a 6.5% when you purchase your home, you would get a 4.5% interest rate in the first year because that's 2 points lower than the going rate. Permanent buy down. This allows you to pay a lump sum of money upfront by paying points in order to get a lower mortgage. For example, if the going rate today is 6.5%, you could pay 1 point. 1 point is just equal to 1% of the loan amount. You pay that 1 point and you end up getting a 6% rate instead. Now, these are just example numbers. You really have to talk to a trusted lender to see what the point equals in rate reduction in your specific situation. To recap, there are 3 ways you can lower your monthly payment today without having to wait for rates to drop. And those are ARM loans, temporary buy-downs, permanent buy-downs. Now, it's key that you know each of these has their pros and their cons, a situation when they should be used and shouldn't be used. It is critically important that you discuss these in detail with a trusted loan advisor. Number 3, improve your credit score. When interest rates are high, it's more important than ever to have your credit in tip-top shape. While a 640 FICO score can get you into that first home, a 740 FICO gets you the best rates and saves you thousands of dollars over the life of the loan. Number 4, keep your eye on the long-term picture. Remember, if you buy now and rates drop further, you can always refinance into a lower rate. But if you wait for rates to drop, an unintended consequence could be that prices rise. Yes, you get a lower rate, but you paid more for that home. If you buy when rates are high, you can lock down a lower purchase price and then refinance later into a lower rate, which would eventually give you the best of both worlds, that lower home price and that lower rate. Now, let's talk about the top 3 things that you shouldn't be doing. But before we do, make sure to like this video if you're finding it helpful and drop any questions that you have so far. Okay, so the number 1 thing you should not be doing is, can you guess? That's right, you should not be trying to time the market. Rates are unpredictable. Instead of waiting for that perfect interest rate, focus on finding the right home and the right payment for you. Number 2, do not drain your savings. Make sure that you're keeping a cushion for repairs, emergency, and lifestyle adjustments. Number 3, don't be afraid to shop around for quotes. A lot of times, my clients are afraid that if their credit gets pulled by multiple lenders, it will negatively affect them. Here's the good news. Multiple credit inquiries for the same type of loan, for example, a mortgage loan, are generally grouped together into a single inquiry. If they occur within a specific shopping window, typically 45 days, this grace period prevents your credit score from being penalized for comparing offers from multiple lenders. Okay, and I'm going to give you a bonus lesson I learned here. Don't wait until you find a home that you love to work on your loan strategy. If you wait until you find that home that you thought would never pop up on the market, it might be too late. Between shopping for lenders, finding the right product, comparing quotes, you might just run out of time. You really want to start the pre-approval process about a month before you're ready to start touring homes. If you take nothing else away from this video, make sure to remember this. Finding a high interest rate market isn't about waiting for the perfect number. It's about planning smart, knowing your options, and being ready when the right home does come on the market.